Joining us is Charles Biderman. He's the CEO of TrimTabs Investment Research and portfolio manager of the Advisor Shares TrimTabs Float Shrink Actively Managed ETF. He says, as I mentioned, the biggest wave of corporate selling since last May is a sign to be cautious. Charles, good to have you here. Good afternoon.
Thanks for having me.
Hey, we're going to talk about what you're seeing in terms of corporate selling in just a moment, but we did just hear from Steve Roach. He says the crisis is over. It's time to think about producing more normal interest rates and get more normalized returns to lenders. Do you agree with him?
Well, no, I disagree with him. I think that the economy is not as strong as the numbers that the BEA and BLS have been putting out lately. And that's, if you really listen to what Chairman Bernanke was saying, is that he doesn't see the economy as strong as what Wall Street now believes. There is no recovery really going on. There's a modest, very sluggish recovery where not enough new jobs are being created to give people who are entering the labor force jobs. We're falling behind, and now we're having a spike in inflation. So things don't look good to me going forward. Is
that where we're starting to see the markets kind of settle in here, start to maybe pull back a little bit in your view, that, you know, people are finally kind of realizing what those comments from Ben Bernanke really mean? I mean, keeping rates low, I know that's free, easy money, essentially, and helping to drive up a lot of asset classes, as we've seen over the last couple of years. But at the same time, it also says things are not so good out there.
Well, as I've been saying and on this show, going back to January of 2010, the market's rigged. The Fed's been rigging the market. They admit that they want to have asset prices be as high as possible. And so all this free money has given corporate America had the huge record amount of cash on their balance sheet, and the only source of cash that has taken stock prices higher has been corporate buying of their own shares. And now it looks as if not only is corporate buying of their own shares slowing, but corporate selling is picking up, ramping up, and that's typically what you'd expect to see at the end of a run.
It's what you would expect to see, but is it something above normal that it's enough that you're pointing it out and says that maybe it's a sign of some kind of either correction or at least cautious trend that might be coming?
Well, 1 week I was just noticing it. 2 weeks I started talking about it. Now it's into 3 weeks. And so far, March sell-buy ratio is 24-25 to 1. The sell-buy ratio of insiders in February was 12 to 1, and in January was 5 to 1.
So big jump there.
Big jump there. The other key indicator is there are no new cash takeovers. And there have been, well, I say no, there's like 2 to 4 billion the last 2 months, and it was 15 billion a month last year on average. So companies are saying they don't want to buy other companies for cash. They're buying back their own shares because they got all this cash sitting on their balance sheet earning nothing. And so that's what they're doing with it. But now they're starting to sell, and the new offerings are coming out. The IPOs are coming out. We're getting into a season where the insiders and the companies have said, you know, maybe they want to sell at these prices, not buy. All
right, so Charles, that begs the question about a correction. Earlier today on Inside Track, Skybridge Capital's Troy Gajewski, he gave his outlook on U.S. stocks. Listen up, everyone.
You have implied volatility at extremely low levels. You've had a significant rally. So if anything, the trajectory of further increases will be much more shallow than it has been recently. We're not calling for a big pullback in the near term, but we do think the risk-reward of being long equities in particular has faded dramatically.
So Charles, Troy Gajewski, he's not looking for any kind of significant correction here, but what about you? Are you?
Well, in the last 2 years, we had a very strong first 3-4 months of the year rally. We had that in 2010, we had that in 2011, and we've had it in 2012. In 11 and 12, we had significant mid-year sell-offs. I don't see why this is any different, particularly since the economy, the real numbers, are weaker than what conventional wisdom thinks, and the reality is starting to come through. It started to come through in real estate numbers, given that how strong the seasonal adjustments were, and how big the investor, I mean, the people who are buying as an investment, not to live in a house on the low end. So if you back that out, real demand is not there. Wage and salary growth is not there. So I'm sorry, I'm a little more cautious than most.
Well, don't be sorry, but if you're more cautious then, I mean, give me an idea. If you're looking for a correction, what kind of correction might we see and how soon?
Well, last year when prices got down to about below 1250 on the S&P, or we started to see significant amount of insider buying. Below 1200, there was a lot of insider buying. Will it get down there? I don't know, but that's where I see a lot of support from insiders, so it could.
What's your advice?
I'm talking about the S&P 500. I say 1250.
No, I got it. I mean, so what's your advice to investors at this point? Talked with Barry Knapp. He was a little bit more defensive. I mean, there are folks out there like Tom Lee who still think things are good and, is upbeat about this market.
Well, the thing to be upbeat about is since October, $4 trillion in wealth was created by higher stock prices. At the same time, take-home pay is up by $200 billion. So people have made another $200 billion, or about 2% on the take-home pay, net of inflation. And we're seeing a dramatic increase in wealth for people who have stocks. That's not a recovery. That's a bounce in the market, and there's no pickup in the economy underneath it. And the Fed's rigging stock prices.
Harsh words. So 20 seconds here. So what's your advice to investors at this point?
Be very cautious. We could have inflation and interest rates and deflation in the economy, or as deleveraging goes on at the same time. And as you have to invest accordingly.
All right, we got to run. Charles, thank you so much. We appreciate you carving out some time for us this afternoon.
Thanks for having me. I've enjoyed it, as always.
We have as well. Charles Biderman of TrimTabs.